Hi everyone, and welcome to today's webinar, Mortgage Basics and Newcomer's Guide to Financing a Home in Canada. My name is Abigail Kingswood, and I work with our partners here at CanadaVisa, like TD, and I'm very excited that you're all here to join us today for this presentation. We're going to start our webinar with a presentation by our guest from TD Bank, and after we'll move into our question and answer period, which will give you the opportunity to interact with our guest. We did have many of you submit questions prior to the webinar, and we're going to try to answer as many of those as we can. And we'd also like if you can continue to submit your questions throughout the presentation. And we have a team of moderators who are looking through the chat and will pull out those questions and add them to the queue. I'm now happy to introduce our guest speaker, Darwin. Darwin is a mobile mortgage specialist at TD, and he's been at TD for over 10 years, progressing to different retail banking roles in the Toronto area. In his current role, he helps homebuyers with their home financing needs with a specialized focus on new to Canada. In his spare time, Darwin enjoys video games, cooking, learning new skills, and all things tech. So thank you so much for joining us, Darwin. Again, we're going to have ample time at the end of the webinar for any questions, so please do continue to ask those throughout in the chat. Also, do remember that the chat is public, so please do not share any personal information such as phone number or email, as those messages will be removed from the chat. Note that the presentation slides and a recording of the webinar will be shared with you via email after the webinar. So now I'm very happy to hand off this presentation to Darwin to talk to you today. Thanks, everybody.
All right, thank you so much for the intro, and good day, everyone. I was going to lead with good morning, but then just seeing in the chat and the engagement, it's really great to see people tuning in from all across the world, all across the country. I saw in part of the chat there was a good presence in Ontario locally here, some people in Montreal, some in Alberta, people across the world spanning into Ethiopia, Nigeria, Kenya, and many other places as well. So great to see lots of engagement and people tuning in all different times to learn about mortgages in Canada. So yeah, I'm a mortgage specialist with TD Canada Trust. Been fortunate to present this presentation with a number of groups like yourselves previously, and it's been pretty well received in past, and we look forward to helping share some information with you nice folks as well. For today's agenda, we're going to be going through questions to ask and consider when you're looking to buy a home, reviewing an example budget of what to expect when you purchase your first home as compared to potentially renting your first home here in Canada. What is a mortgage and different types of mortgage rates you can consider. Understanding down payments and the requirement thresholds around purchases with how much capital you need to have initially to purchase. Understanding mortgage pre-approvals, understanding mortgage prepayments, and then also next steps to reach out potentially to TD or your preferred bank for a pre-approval or any other questions as it pertains to your unique situation. Right, so questions to ask when deciding on buying a home and cost to consider. So purchasing a home is a long-term decision, and so a lot of people purchase. It's one of their biggest goals when they first arrive to Canada is where they want to plant their roots, where they want to start their family, and where they want to settle for a while. But the landscape throughout the GTA, or actually not just I'm in GTA, but in Canada, is always changing, and I find the majority of people that settle here often tend to rent first as they start to establish credit in Canada and want to find out how they can go about home purchasing. And so some of the questions you may want to consider as you look into a more long-term decision of buying and staying in Canada would be, where do you want to live long-term? What neighborhood would you like? Do you want to be close to transit, schools, and shopping? What kind of property do you want to own? Do you have enough money set aside for the down payment to purchase? And what will my mortgage payments look like? So one thing I want to call out here is that a majority of people, I think the ideal home to a number of people tends to look very similar, right? And what I mean by that is everybody wants to be, close to good public transit. They want to be close to good schools, in the best neighborhoods, have a more ideal traditional family home with a lot of space for family to grow and so on. But when we look at homes and budgeting, um, with all of these factors that majority of people want, they tend to drive up home values through just, as with supply and demand, a home that's closer to downtown may often be a bit more expensive than a home that's a little bit further outside of the city. So when you want to consider these items and prioritize what's important to you, you want to almost rank them and kind of decide which of these features is most important to you so that you can go about looking at homes that fit your budget best, that also prioritize your core, the your core values and core expectations with your home, and leave some of the other more preferences as bonuses or extra things that would be considered but not as a priority when you're considering your purchase. So owning a home in Canada can cost a lot more than you would expect. This is relative to potentially renting. So generally with renting, a home, then most people will have a long-term lease with a landlord with a set monthly payment that's not expected to change too frequently. Often these are most commonly in 1 year lease periods, and you would pay the same amount of rent every month. And then it may or may not get adjusted annually. But apart from this, your rent amount includes most of what you're going to pay for your living cost in Canada, apart from some utilities that you use and some maybe month-to-month subscriptions for like internet or phone cable and so on for your personal use, right? So with home ownership introduces a lot of other payments beyond just the mortgage payments. The mortgage payment being the loan payment used to help you purchase the home itself. But separate from this, you also have considerations like property and school taxes. So some municipalities charge property taxes, but they also charge school taxes as well. Whereas some way will they'll charge varying rates depending on demand or population density or just how the municipalities have it set up. Different property types may or may not have condo or sometimes called strata fees. So these are communal costs for services that may include things like um, garbage and garbage disposal, landscaping, security, concierge, stuff like that, perhaps within your building or complex. So condo fees are an extra ongoing cost to consider with potential different purchase types. There's home and condo insurance, both for purchase and rental. But as you can imagine, for home ownership, often insurance can be more expensive because beyond just your possessions, the insurer also has to insure for the property value itself in case there's any damage to your home, for instance, like fire damage, water damage, or things of that nature. Utilities are an extra expense as well to consider, and then emergency and maintenance costs. So emergency and maintenance costs, while listed last year, it's definitely not to be understated. Sometimes these emergency maintenance costs can be one-off expenses that are not common to your month-to-month budget, but they can be substantially expensive. You may need to replace something like maybe your garage door breaks and you need to fix that, or there's water damage to your roof and you need to fix that. Could be a number of things, like, or just some kind of damage to the building itself. Um, these can range from small expenses to very substantial expenses. So apart from your month-to-month budget, with renting, if something happens, you usually reach out to the landlord. It's part of their expected expenses and they manage this for you. Whereas as a homeowner, if any of these instances come up, you ideally would have a plan in place and access to additional capital to set aside for some of these extra unexpected expenses. So here's an example budget that you can consider for roughly about $3,500 and what a breakdown typically would look like. Myself, I live within GTA. I would say that this budget would most likely probably mirror a starter, perhaps one bedroom, one plus den, or in some instances, maybe a two-bedroom condo, with a mortgage amount of $2,250. At today rates, this would be roughly, and rates are always subject to change, but let's say this would be for a mortgage in and around 400,000, give or take. And then on top of that, you'd have your property taxes and school taxes, condo fees per month, home insurance, utilities, and emergency maintenance costs. And so with the emergency and maintenance costs, I would say, just to be safe, if you're more conservative like myself, this may not be enough. Like I would say you'd probably still want to have some kind of rainy day fund or set aside a little bit more. It's always nice to just have a bit of a buffer, right? So if you were to compare renting per month for in GTA, let's say average rents, depending on the size of unit you're looking for, between $2,000 to $3,000 a month, you can see how comparing that just to a mortgage payment alone is not quite enough with all those extra costs we mentioned initially. So what is a mortgage? So I'm going to read the kind of definition here first and kind of just paraphrase in a more friendly lingo, we'll say. So a mortgage is a loan commonly used to finance the purchase of your home. The property is the security for the loan. A mortgage has an amortization period and payments that typically include principal and interest. Right? So a mortgage is the amount of money that you borrow from the lender to pay the seller for the portion of the home that you are not purchasing from your own cash today. And with that loan, when it says that the property is secured for the loan, that just means the house is pledged as collateral for this loan. In that, if the lender has the security that if the loan isn't repaid, they can recoup losses from the value of the home itself in the in the future if the loan payments aren't made. A common like mix up of terminology with mortgages is the amortization period and the mortgage term. So I'll read these two first. The amortization period is the time it would take to pay off the mortgage, assuming no change to payment amount or interest rate. Many people choose a 25-year amortization period. The longer the amortization period, the more interest you will pay over the life of the mortgage. The mortgage term is different than the amortization period. The mortgage term is the length of time you've committed to a mortgage interest rate and payment to your mortgage lender, right? So if we look here at the graph or diagram here, we'll notice specifically that along the bottom, this is the length of time it will take to pay off the mortgage in years. So this total time frame down below being 25 years would be the amortization period. So the amortization period sets the pace that you're going to pay off that loan to completion to eventually, have the loan paid off and not owe any more any more debt on the property. The mortgage term is different in that when you first get your mortgage with the bank, oftentimes your mortgage term is not set for the whole amortization period of the loan. It's only set for a number of years. So in this example, we have the first 5 years highlighted in green. As denoted up top, this would be the mortgage term, right? So you only have a set interest rate negotiated with your bank and a set expected monthly payment to be paid for the first 5 years of your term. At the end of your term, you would have remaining 20 years left to pay off the mortgage. And at that time, you could refinance your mortgage to reset the conditions of your loan, or you can just renew the mortgage with the same bank and carry on for the remainder of the last 20 years, picking a new interest rate and term and carrying forward with the loan. So mortgage interest rates. The mortgage interest rate is the percentage amount of interest charged on your mortgage. There are two types of mortgage interest rates. Most people know these, fixed and variable. So for fixed interest rates, the interest rate will not change throughout the term of your mortgage loan. As an example, if you got a 3-year mortgage today at 4%, that means for the duration of the 3 years you're paying off your mortgage, every payment and every interest calculation is going to be pegged at 4% for the full 3 years term of your mortgage, right? With a variable mortgage payment, the interest rate can fluctuate through the term as the base interest rate changes. Each financial institution will have their own base interest rate. So with a variable interest rate, the main takeaway here is that unlike with the fixed rate, the interest rate or calculation can fluctuate with your payments. And so as an example, let's say today you got a same thing, let's say you got a 3-year variable rate at 4% like the fixed rate. But just as it happens yesterday, we had a Bank of Canada announcement that the Bank of Canada prime rate would drop 0.25%. So resultantly today, TD and a number of most likely the other big banks as well, and most lenders will also drop their prime rate. And if all things equal, if their prime rate dropped 0.25, starting from an aggregate rate of 4%, then today borrowers would benefit from a new adjusted rate of 3.75% instead of 4%. So with variable rate, there's two types of variable rate products. With TD, we have a set payment for our mortgage, variable rate mortgages. This means that as interest rate moves up and down with the Bank of Canada and TD's mortgage prime rate, the portion of interest and principal paid will adjust, but your monthly payments will stay the same. So if your monthly payment's staying the same and the interest rate has fallen, you'll resultantly pay more principal per month and less interest per month. And the reverse is true. If you're paying the same amount and interest rates increase, prime rate increases, you're now paying a larger portion of your payment to interest and a lesser portion to principal. So at the end of your mortgage term, if you don't change your payments at all, you may not necessarily be exactly on course with your original intended amortization, right? And to contrast that, there are lenders that have an adjusting payment with their variable mortgage. What this means is as the variable rate changes with prime rates, their payments will also move up and down, right? So those are just, the, I guess the summarized differences between fixed and variable. Now for down payment. So the down payment is the amount of the purchase price of the home that is not being financed, and you pay this up on closing. Some lenders have mortgage solutions tailored to newcomers that they may have a specific minimum down payment requirements. Note in Canada, mortgage default insurance is required of putting less than 20% down payment of the home purchase price. This amount is added onto your mortgage principal, or you can pay it as a one-time amount upfront. So what this means is that, or what down payment is let's say, for example, you purchased a $500,000 home. If you got a mortgage of, we'll say 80% being 400,000, then 400,000 is borrowed through a mortgage to pay for the home, and the difference of 100,000 is still owed to the seller to complete this purchase. That is paid on closing, as mentioned here, to the seller from your own existing capital, your down payment, right? And so the second point here just mentions that in Canada, with all regulated lenders, you need to have at least 20% down payment if you want to avoid the necessity to pay what's called default insurance. So with default insurance, let's say, for example, you want to purchase today the same $500,000 property, but you only have 10% down payment, right? So in this case, as it's mentioned here, your down payment is less than 20%, so you would be required to have mortgage default insurance. What mortgage default insurance is it's insurance for the lender that's added through one of three Canadian Crown Corps, CMHC, Sagen, Canada Guarantee. That is, there's a premium or insurance amount that you have to pay that is normally added to the loan and amortized with the mortgage. So keeping the same example, if you wanted to buy 500,000, you have a 10% down payment of 50,000. So now you're borrowing 90%. The CMHC premium or Genworth Sagen Canada Guarantee premium would be added to the mortgage principal. So in this case, you would borrow 450,000 plus a default insurance premium to pay for the remaining 90%. Right? And so with insured mortgages, they do have different underwriting or approval criteria, different underwriting criteria, and these are just a more specific niche mortgage type. But as an FYI for those interested, so less than 20% down payment requires default insurance in Canada for first-time buyers. um, the minimum down payment required is 5% of the purchase price up to $500,000. And the maximum purchase price is up to 1.5 million. And the minimum down payment required is 5% for the first 500,000 and 10% for the balance. Right? So if you don't have 20% down payment and you're still looking to purchase up to 1.5 million as a first-time buyer, then the minimum down payment required follows that formula I just mentioned. So getting pre-approved for a mortgage. A pre-approval is when a potential mortgage lender looks at your finances and decides how much they might lend you and at what interest rate they'll charge, subject to certain conditions. You might end up being pre-approved for an amount greater than you want to borrow. This doesn't mean that you need to borrow all of it, but you can create a budget with this number in mind, and so that you can make sure to follow it and plan accordingly. So a pre-approval essentially is when you walk into a bank or a lender and you ask them, you describe your situation of your current household income, your current savings, your credit worthiness. Often a credit check is done and they submit through a formal application as if you were purchasing a home today. But the main difference is there is no property tagged to this application. So the bank is just looking to see, with your current credential, could you purchase? You can either do it one of two ways. You can ask the bank to give you a pre-approval for as much as they think that they will lend to you. So you can get a max pre-approval to get an idea of how much you can purchase up to. Or if you have a budget in mind already, you might say, okay, well, we're looking at homes for in the range of $600,000 or $700,000. Is this something we can afford? And they can do a pre-approval for that set amount as well. Typically myself, if we're doing the latter scenario, I would usually recommend clients to allocate a bit of a buffer, maybe 30 to 50,000 higher than their target purchase price, just so they have confidence in bidding, knowing that we've already vetted their scenario and that we are confident we can back a higher lending amount. But also accounting for there might be a bidding situation where you might have to purchase the home you're looking at a little bit higher than expected, and so we've accounted for those additional numbers as well. A couple callouts with pre-approvals I'd like to mention here. So one is a pre-approval is not a commitment to proceed with the bank that you're applying with. So a lot of times people are worried about getting a pre-approval, and I think they're doing themselves a disservice. A pre-approval just gives you confidence in bidding in the market. It allows you to book a potential interest rate with the bank. Usually if rates lower, the lender is more than happy to reduce rates to current market competitive for you. But if rates should increase, then we'll honor the rate that's booked for you already. Right? But getting a pre-approval in hand just allows you to, it alleviates the likeliness of any unexpected things that could come up later in a live application when there's a lot more pressure to kind of get the application approved. An unexpected example would be maybe any kind of conflicting information with your credit bureau, discrepancy with income or something like that. So you want to have everything looked at up front first. Make sure everything is good before you're out in the market looking at places. And a lot of real estate agents will prefer you to have a pre-approval in hand already before they take you looking at homes. A second thing to mention with pre-approvals is kind of mentioned already. I always tell clients, think of rates booked in a pre-approval as a rate ceiling. If rates increase, you get to keep the rate that you booked. If rates decrease, then we'll rebook rates for you. Right, so really no downside of getting a pre-approval. Certainly a good thing to consider. Right, so why get a pre-approval? Pre-approval helps you understand the amount you may be able to borrow and locks in an interest rate for a period which varies by mortgage lender. Getting pre-approved is not a promise that you will be approved for the mortgage. make sure you read and understand all conditions of the pre-approval. So just a call out here, a lot of times people think a pre-approval means that they're also guaranteed that they will get financing for that amount on a property. So let's say, for example, you purchased a home that originally we expected that you were going to purchase a home with a pre-approval for $500,000, and this was going to be for a single family home. And eventually you ended up purchasing perhaps a condo townhouse or a high-rise condo that had higher than typical condo fees, let's say even as much as $1,000 a month, that wasn't factored into your pre-approval. Well, this would change your ability to potentially carry on payments and to fulfill the payments of the loan and the housing costs of this new application. And so your resultant approval on a live deal might actually be less than what you originally applied for. And the reverse is actually very often true too, where oftentimes we can approve you for higher than what we originally approved you on a pre-approval on a live deal as well. So a pre-approval is kind of just like an estimated snapshot, but it does not guarantee financing. We also haven't looked at the property after a pre-approval, right? So you could be pre-approved as a credit-worthy borrower, but you might buy a home that the bank feels is perhaps maybe it's really really old and in disrepair and doesn't satisfy the bank's property lending conditions, and so we might not approve a live deal, not because we don't want to approve you as a borrower, but because there's concerns with the property that's being purchased. Right. So that's what this note is calling out. Mortgage prepayments. So you can make additional payments to pay off the mortgage sooner. These are called prepayments and could be in the form of lump sum payments or increasing your regular payments. Mortgage lenders can have different prepayment options. Prepayment privilege is the maximum prepayment without paying a prepayment charge and will vary by mortgage lender and mortgage type. So the reason that we're discussing prepayments is the vast majority of mortgage rates in Canada are quoted on what's called closed mortgages. And so a closed mortgage is a loan type where you cannot just end the mortgage at any point in time you like if you've committed to a set term, the term of your mortgage, to a term of repayment or honoring the conditions of that mortgage. So if you got a 5-year fixed mortgage today and you decided to sell your home a year later and break that mortgage, well, to the bank, you've now ended your contract 4 years early. And a contract, of course, is a binding contract. So with closed mortgages, you don't have unlimited prepayment, or you can't end the contract at any time. But you can reduce the mortgage balance if you have additional savings on hand, if you come into funds, maybe sell some investments or other assets. You can pay down the loan faster within tolerable ranges. Right, so with TD, we allow you to prepay up to 15% of the original borrowed amount each calendar year. We also separately allow you to increase payments of your regular loan scheduled payments up to 100% of the original borrowed amount. Knowing this is really, really important though for your long-term plans of your just financial health and what your plans are with building your wealth. What I mean by this is on a typical mortgage today, and these are just average numbers and the subject to change as rates change and so on, but I would say for most 30-year amortized mortgages today, if a buyer is just paying the minimum payments only, they would probably, and they look at the amount of payments they've paid in the first term of their mortgage, the total of all their principal and interest payments, it's not uncommon that while you may only have a 4% interest rate or 3 point something, 4, like 5 point something, and so on, when you look at the interest amount to principal paid, because the um, the loan is largest in your first term and getting smaller, so you're paying more interest upfront and less principal upfront, and then more and more principal throughout the time of the amortization of your mortgage. It's not uncommon that if you look back at your total payments, you might pay as much as, we'll say, 60 to 70% of your payments as interest payments, and the remainder as principal. So another way to say that is for every $1,000 of mortgage payment you'd be paying, you might only be paying, say, $300 of principal. But another way to interpret that is to say, well, for every $1,000 of mortgage payment, if you could increase your payment up to $1,300 per month, you'd in effect be paying your principal down twice as fast for that extra 30% payment, right? So prepayments really go a long way with saving you interest costs in the long run. And so if you can make prepayments, or comparing prepayment features with lenders is a really, really important consideration beyond just rate and other features of your mortgage. So next steps, TD can help you finance your first home in Canada with specially designed mortgage solutions for newcomers. You may be eligible for a TD mortgage, even if you have no Canadian credit history, provided you meet the eligibility and criteria at TD. And then here's a web link with more information for mortgages for our new to Canada borrowers. You can request a call from a TD mortgage specialist like myself to learn about our mortgage options after you have arrived in Canada. Right, and with that, we're going to open the floor to questions for anybody that has any questions related to the content mentioned or anything you've brought into today that you wanted answered as well.
Great. Thank you so much for that presentation, Darwin. That was very informative, and we've had various questions come through in the chat throughout the presentation. So we're going to now move into answering as many of those as possible. So to start, we'll start with a question from the chat about pre-approval. Eileen asks, what evaluation criteria do lenders use to calculate pre-approval?
Yeah, so there's a number of things that lenders will look at, but typically I would say, if I'm broadly speaking, a huge majority of most mortgage applications not following special lending programs is typically going to be based on household income, right? So with household income, generally for newcomers, as majority of a lot of the listeners may be, typically we would want to see employments anywhere between at least 3 to 6 months with a full-time employer in Canada. And generally we're looking for people that are either perhaps relocated to Canada with an employer they previously already worked with and have good a good track record and history of employment with already, or they're working in a new stable job today and they have already cleared their probation period, right? And then hopefully they've building good credit habits as well. And then we would just follow standard stress test guidelines to review that file.
Great, thank you. So various questions submitted prior to the webinar asked how to determine and build credit score before arriving in Canada.
So that's a great question. I've never personally considered that before. Um, having been born and just born in Canada and building credit here organically myself. I don't know personally if you can apply online. I mean, we do allow clients online, like new accounts and so on. Typically, they would need to go into a branch though to authenticate and find. I suspect that it would be fairly difficult to open new credit products without any um, Canadian footing already, whether it's some kind of an address. Um, the Yeah, I would say that generally speaking, for most initial trades that people are opening to start building credit, would be even sometimes people haven't even started getting credit yet, but the first couple items that may indicate good credit habits would be proof of a lease. They're already renting a home here before they've opened new credit accounts. And we might get a letter or some kind of confirmation from the landlord or proof of rent payments being made that there's good proof of repayment there. A lot of the time we might consider credit from abroad if the home country has a credit bureau system like us, then we'll look at credit score and 6 months proof of credit repayments from outside Canada. But I guess it's going to vary with each bank and lender, their processes for setting up new credit trades to start building score here without actually being here.
Great, thank you. Okay, another question, various individuals asked a question similar to this. about the relation between having a job and purchasing a home. Do you need to have a part-time job or a full-time job, or what is required to get a mortgage?
Yep. So we don't discern too much from part-time to full-time, although generally speaking, part-time jobs, because there's less hours worked and most wages are set on it like an hourly rate. Part-time jobs, if I'm generalizing, will tend to be a lower annualized income than a full-time job. But for us, I mean, we look at we look more at the total annualized income and less the income type, right? And so what I mean by that is there would be no preference for someone with a full-time job, say making 60,000 a year, as opposed to someone with two part-time jobs making 40,000 in one and 20,000 in the other. The main call out though for someone considering part-time work versus with our applications. With part-time, there tends to be a lot of variance. Someone might be part-time and work 15 hours this week, 30 hours next week, or they may even have a very set schedule of and a soft agreement but not guaranteed. They may work, for example, 30 hours a week. But if your part-time contract is that you are only guaranteed a minimum of 15 hours a week, even though you're working 30, most lenders for that part-time applicant are going to use that 15-hour guaranteed minimum because we don't have a 2-year history to go on and it's not guaranteed hours, right? So that is a disadvantage, I would say, in the underwriting of a part-time employer, of a part-time employed applicant. But whatever income we can confirm, there isn't preference to full-time or part-time.
Great, thank you. Okay. Um, let's see. Okay, a question submitted prior. What additional costs should I budget for besides down payment?
So great question. Because other than down payments, I would say at minimum, if the goal is to purchase as soon as possible, and I still would generally, in traditional finance advice, it's generally recommended you always have a bit of a rainy day fund, an emergency fund, or more commonly these days, perhaps maybe a family backup or someone that can help you out in a pinch or something like that. But if you're looking at what you should save to complete a purchase at minimum on your own, then down payment, of course, is going to be the first thing. And the second thing is going to be your closing costs for purchasing. And what tends to be, by and large, typically the largest closing cost to consider is typically going to be your land transfer tax. So I would recommend anybody looking to purchase, if they have an idea of what homes they're looking for and what area they're likely to purchase in, that they can just quickly search, a land transfer tax calculator for their area, plug in the property price, and that's going to give you a partial but majority closing cost to consider. And then separate of that, you're going to want to consider things like potentially anything for repairs. Maybe after you move in, you need to update the home a bit. Fresh coat of paint is very common for new buyers. Sometimes when you purchase, if you're purchasing, say, earlier in the year, maybe the current seller has paid the annual property taxes already. I've seen often sometimes it's negotiated in the contract that the new buyer would have to pay back the prorated portion of the property taxes not used from the current seller. So if they sell in May after 5 months, the new buyer might have to pay back seven out of like 7/12 or 7 months worth of property tax back to the seller. That would be an extra closing cost, lawyer fees, and any other kind of miscellaneous expenses. For closing costs, though, your expert in this area is generally going to be your real estate lawyer, so they can give you a fuller answer beyond that.
We've had a few questions submitted prior and also during the presentation about the FHSA, if that is available to newcomers and non-residents.
FHSA, honestly, I haven't checked the base requirement for opening the FHSA. I don't open them myself. I just know that in the home buying process, as a source of down payment or a preferred investment registered plan vehicle, the FHSA is probably the best thing to start investing in. So This is kind of a partial answer, unfortunately. I would say double check with any advisor in the bank that opens these accounts is going to know the minimum requirements and eligibility for that. But as far as the FHSA itself, phenomenal type registered product, and it should be the first type account that you start maximizing before RSP for first time home buyer, and then perhaps before a TFSA, before other just non-registered savings, because there's a lot of benefit there. For those that didn't ask the question, they're unfamiliar, the FHSA is kind of the best of both worlds, I like to put it, of the RSP and the TFSA or tax-free saving account programs, in that when you put money into the FHSA, you do get an income tax credit or like a proportioned tax refund or credit on your tax filing for that year. So you get money back for putting it into this account. But when you withdraw it, unlike the RSP, you do not have to replenish this account, right? And in the money that's invested in the FHSA, like the TFSA, any growth, investment gains, or interest gains, or anything like that is also not taxable. And from a flexibility perspective, there isn't a 90-day holding period like a standard RSP. You can withdraw it very shortly after opening the account as well. And another important note with this one is the FHSA, there is carry forward room of up to 1 year. And however, and I got caught with this myself, I had read and understood that you can carry forward unused room in the FHSA. However, this is a great time to mention this too, because we're near the end of the year, but the FHSA carry forward room is only relevant if you have opened an account. So this is saying that even if you may not have money today to open to fully capitalize on your FHSA room, but if you plan to use this account to purchase a home in the coming years, I would encourage you to open an account this year. And any room that you haven't used and contributed this year, you can still reuse that next year. You get to, essentially double the contribution room or get this full year's room. But if you don't open the account this year, you lose this year's room. You can't backdate and say, oh, I didn't use it in 2025, even though I would have been eligible to open the account.
Great, thank you. And a question around purchasing a house and renting it out. Are there any restrictions around that, and how can someone go about that?
No, there aren't any restrictions for that. I guess again, a lot of these answers are lending. I mean, mortgages are pretty complex, but and so there's always kind of partial answers here. So there isn't a restriction from the bank that you purchase, and you may want to rent out your place as an investment. Perhaps you're living here with accommodation paid by work or living with family, but you just want to get into the markets. That's not an issue for us. However, we did mention earlier we were talking about purchasing with default insurance or buying with less than 20% down payment. For first-time buyers, if you're buying a single-family home, you cannot purchase a single-family home with less than 20% down payment or a default insured mortgage and have that first home as a rental. Right. So if you're putting less than 20% down, expect that purchase should be intended for primary home use.
Great. Okay, this is a clarifying question from the presentation. This individual asks, did I correctly hear that the sale of property is not a valid break of the contract, but would infer a fine?
Oh, well, actually, so breaking the contract really just entails if you're paying off any of the mortgage above and beyond your prepayment allowance. So, and what I mean by that is you might be breaking the contract for a number of things, right? Or just paying it off early, we'll say. There's no difference whether you were to say inherit money and pay off the whole mortgage and break it early, or if you were to sell your home and break the contract early from the proceeds of sale, the lawyer pays off the mortgage, or perhaps you refinance to another bank and you move the mortgage to another lender. In all cases there, you're breaking the contract, and so there's no difference there. That section was just talking about the importance of prepayment, how that can save you interest, but also the restrictions of prepayment. And again, just reminding there, so our limits were 15% of original borrowed amount each year. You can prepay in one-off lump sums. You can do it as many times as you want throughout the year, up to that total. And separately, you can increase your regular scheduled payments up to 100% more than what you originally start at.
Okay. Various people have asked what your tips would be on how to decide whether to rent or to buy and when to make the switch.
It's a very loaded question. There's like a lot of so I'll preface saying there's no right answer here. The housing market in Canada is very volatile, and people have done exceptionally well on both sides, and also lost a lot of money in some cases as well, right? So I think the main considerations would be, of course, your budget, your long-term plans, um, and also maybe just looking at comparables, historical trend, and what your own kind of expectations with the markets are. I would say that generally, I mean, if there's a general comparison where people will want to say, okay, well, if I can, the common thing you hear online is I don't want to rent because I don't want to pay for someone else's mortgage, and indirectly that leads us to assume that renting would be the same cost or same monthly amount as owning. I would agree if you can buy your home and your monthly payments all in with everything considered would be the same as renting, then of course owning in the long run and just based on historical stats, I've read that I think it's in developed countries every 7 years on average, um, home prices have doubled. And so if you're looking to own for the long term, you're paying roughly the same amount and you can manage it. You're not expecting to incur substantial closing costs from selling early or anything because it suits your plan. Then a mortgage would make sense because rents do tend to increase over time, whereas mortgage payments, all things equal, will tend to be the same or lower. And what I mean by that is after the mortgage term, there's nothing stopping you from reapplying and refinancing for that mortgage, re-extending the loan or re-amortizing it to lower payments. Or if all things were equal, your payments would be the same. But renting does have some, I guess, overhanging things with it, like you might be evicted, the landlord may sell the place. You may have to find a new home. They may increase rents. Right now, in the last year or two, rents have been falling a bit. I suspect once, if the market rebounds and recovers, the landlords be quick to increase rents back to previous levels again as well. And so there's a lot of things to look at there. But I would say also on the buying side, I would just caution people to be careful of overextending themselves because they overextend themselves and rates increase, or they haven't planned for unexpected expenses related to the home, and they're forced to sell or something. It could be very, very costly. So just make sure that if you're buying, I think there is a lot of upside there, but you need to make sure that it's something you can commit to for a long time, and that remains the plan. But then over time, you should do better. Uh, I would postulate, or would be my opinion for a long-term approach.
And this is probably our last question, just building on that a little bit. We had a pre-submitted question. How should I know how much I need to have saved before I can purchase a home?
So the shortest, easiest answer for this is just going to be looking at that pre-approval, right? So because for you might purchase a place for we use the same number, 500,000, and if you have a very substantial income, you may need very little down payments. You could purchase right away with 5% down payment, 25,000 minimum down payments, plus closing costs, and your income is going to carry that application. You can purchase quite soon. Could be someone that has a more moderate income that needs to save up a lot more. And so it's getting a pre-approval will not only just tell you how much you can get now, but you can also ask your lender, okay, well, this is where I am today, but this is where I expect my career growth to be within the next 2 years after I finish a degree, after I get this designation, after I get promoted or move to this type career. This is how much I expect to earn, and within the next 2 years, this is how much I think I will have saved. What would my purchase look like then, right? And they can kind of look with you at the type of property you're looking at and where you are today to let you know what you would need to accomplish to bridge that difference, whether it's your income needs to grow to a certain level or you need to accumulate or come up with a certain threshold of down payment. But getting that initial estimate would be easiest for your scenario with a pre-approval from a mortgage specialist.
Great. Thank you so much. We got through a lot of those questions. So thank you very much, Darwin, and thank you for your presentation. That was very informative. Just a note, if you're looking for more information, we have various articles on related topics on CIC News. So please feel free to visit and scan through those articles to try to get answers to other questions that may come up or just learn more. And we will be sharing this presentation, a recording of it, as well as the slide deck to you via email tomorrow. So you should watch out for that in your inbox. And thank you, everybody, for coming. And a big thanks to Darwin for the presentation. We'll hope to see you again.
I look forward to it. Thank you, everybody, for tuning in, and have a great rest of the day.
Thanks, everybody.